So welcome back to this week's video, and this week I want to take on a topic which I'm surprised I haven't covered already. I certainly write about it regularly in the magazine, and one or two people have asked about, so let's do it here. It's the cyclically adjusted PE ratio, or the Shiller PE, named after the Yale professor that came up with it. That's S-H-I-L-L-E-R, or the CAPE, C-A-P-E. What is it, and why do we like it? Well, it's actually one of our favourite valuation ratios, and the reason is very simple. PE ratios by themselves are pretty good valuation metrics. A piece of research at the end of last year by Vanguard revealed that of 10 valuation metrics, the PE ratio since 1926 has been one of the better predictors of what will happen next over a decent period. Not short term, it's not a trading sort of valuation metric, but for long-term investors, you get a decent feel for what's going to happen next through a PE ratio. And we like the cyclically adjusted PE ratio because it refines things slightly further still. Now, I'll mention what it is, I'll mention one other video, and I'll explain one or two downsides to putting a CAPE together. Okay, so with no more ado, PE ratios, Vanguard likes them, we like them. This is the plain vanilla type of PE ratio. What is it? Now, I've done a video, quite an old video, what is a PE ratio? Do take a look at that, because I'll be going fairly quickly here to get to what a CAPE does to a normal PE ratio to make it that bit better. Okay, so a normal PE ratio is basically the current share price for, well, this could be a company, but it could also be done on a sector basis. It can also be done on a sort of whole market or even country basis if you can get the data. But let's say it's individual companies, so it's the share price compared to 1 year's earnings. Right, and it's a multiple, okay? So at the end of it, let's say if you put in, ignore my X, if you put in say 100p as the price, 1 year's earnings on a per share basis might be say 10p, you get a PE ratio of 10 times. That's what I meant to do first time around, okay, 10 times. And basic PE ratios, I'm going fairly quickly, take a look at my PE ratio video for more. Basic PE ratios say, the lower that is, the cheaper the share, expressing the share price as a multiple of 1 year's earnings. Now, the point about the CAPE is this. The CAPE says 1 year's earnings to make a judgment about buying a share is a bit limited. You need more than that. Okay, 1 year's earnings is a bit limited. Now, conventional PE ratios, some of them will use last year's earnings, historic PE. Some of them use a prediction, 1 year ahead, that's a forward PE. Okay? A Shiller PE or a CAPE says what you want to do is take an average over 10 years. All right, so if you can do it, what you want to do is go back over 10 years worth of earnings. Okay, and the PE ratio uses what I call the sort of the net earnings figure. Okay, the only thing that isn't deducted typically is the dividend, the annual dividend. But you're on 10 years worth of earnings, you want to average, so add the whole lot up, which I won't do here, divide by 10, and that gives you earnings over a typical cycle. Okay, because there's a view that, which is contentious by the way, that a typical business cycle, if there is such a thing, will last about 10 years. And you want to capture the typical earnings result on average over that 10-year cycle, okay? Not one specific year where you might be getting a fluctuation, okay, depending on where the business is in the cycle and what's happening to earnings, but you want an average for the past 10 years. So the idea with the Shiller PE is you still compare the latest price, so if you're looking at one company, that's the share price, okay, to an average taken over 10 years, and it still gives you a multiple. So the answer, will still come out if the current share price is 100p and the average over 10 years happens to be 10p, then the multiple's 10 times, and the same rules apply. So the lower that multiple, the better value the share is potentially, the higher it is, the more expensive it is. All right? So there's your basic Shiller PE, that's Robert Shiller, Yale professor, or CAPE, CAPE, cyclically adjusted PE ratio. Okay. Now, a couple of people have written in and said, that's all very well, but where do you get them from? That's a pretty good question. No point in telling you about something and saying, you can't do it. The problem with CAPEs for individual companies is that you've got to put the data together yourself. Now that is true even if you've got access like we have to a Bloomberg terminal. They don't just crunch them out for you, unfortunately. So I tend to have to put these things together myself when I want them or rely on someone else to do it. Can be done, the current share price, that's not too difficult, you'll find that all over the place. And then you'll need 10 years worth of earnings data, and you'll simply have to work out the average and compare one to the others. It's a bit laborious, okay? And once you start to move up away from individual shares to say whole countries, it can be done, but that gets fiddlier still. So I'm afraid the bottom line is, it's a little bit of a fiddly job on individual companies. The data's out there, Digital Look type site or similar, or Hemscott, some of those subscription sites will give you the data, but then you've still got to usually bash out the number. On a country level, trickier still. For those people who sort of want to compare countries and say, which countries are cheap at the moment, well, not easy, but I quite like a site, Marbane Faber, that's FABER.com. Some of this stuff's behind a paywall right now, but Mabane, that's MEBANE, FABER.com, sporadically, he will produce cyclically adjusted PE ratios. And the sort of result you get, these are quite useful when you compare like countries, for example. The sort of result you get is recently, just over a week or so ago, he did an analysis of countries by CAPE, asking the question which ones are cheap. And for those people interested in the answer, I'll just go through the cheapest 5. Greece is currently, I suppose, not surprisingly, very cheap on a CAPE basis. Argentina, Iceland, Russia and Italy are all pretty cheap too. And there are ways you can play that cheapness through, for example, various exchange traded funds, all right? Either country by country or even on a sort of basket basis, all right? So there it is, cyclically adjusted PE ratios in a nutshell. Try to deal with a slight problem with a single year PE ratio, which is the very fact it uses a single year's worth of data, okay? CAPEs are not perfect, neither are pure PE ratios. As a long-term predictor, Vanguard said, well, the CAPE is one of your better bets, but anything up to half the time, you're not going to get an accurate short-term predictor of where the market's going next, but you will get a reasonable longer-term predictor. Practical problem, doing it on single companies, you've got to bash quite a bit of data yourself normally, and stepping up, doing it on whole sectors or countries, you've got to do even more bashing or rely on someone else to do it for you, and there are 1 or 2 people who will do exactly that. Good luck with your value investing hunting.